What's going on, everybody? This is John with the Cash Flow Veteran Podcast. I want to welcome everybody to it. This is episode number 12. The VA home loan is a moral hazard. Now, before we get into all that topic, I want to let you know of a few things that might be coming your way. I did line up some really good guests, people that I've known in my past that I've stumbled across in various ways. And obviously, still, it's mainly kind of a lot of Air Force people because as you get a podcast started or a business started, you start with kind of the people that you know within your network of influence and kind of work your way out there and kind of see what happens. And so obviously being an Air Force guy, you know, a lot of the people that I talk to that I know, that I grew up and the first people that I thought about have certainly been Air Force people. So I do have a couple of guests that are both former Air Force officers, former missileers as well, people that I've talked to at length again and again about about investing in general, home investing and real estate investing, from different strategies of house hacking to the BRRRR method. It's called the buy, rehab, rent, and refi, and then rent again. And then you get the benefit of doing a lot of that stuff, which is some really cool strategies to get into, and we'll certainly get there. But I wanted to kind of lay the groundwork of this with talking about the VA loan first, and I also have some of my real estate mentors that are going to be coming on during this month as well. So we're going to get a lot of really good real estate investing. But I did want to address something obviously from a libertarian perspective, because that's one of the things that I do. I want to shake up your thinking a little bit and start getting you to think a little bit bigger. And making sure that you're controlling how you're getting income, making sure you're actually doing the work in order to control the streams of income that you're going to be getting in, and why you should be thinking quite a bit beyond what you're already doing. Because I'm just going to tell you that pension that you're hoping for at 20 years, and maybe the money you've put into TSP, and hopefully the medical care that you're going to be getting down the road with TRICARE, hopefully that kicks in for you. And honestly, you know, it's worked well for my dad, but my dad's still been in debt basically since his junior year in college. And I don't know that he's ever been out. And of course he's needed that, but he's also been able to do, you know, other things with it, unfortunately, that, you know, hasn't quite set up some of the other things, because you have that backstop there of medical care and some other stuff. So instead of actually being preventative in how you go about it, instead of actually having to feel some of the cash burden, which are some of those mechanisms that when you think about it, if you had to pay for more medical care, you likely would actually take a lot more seriously, rather than having a catch-all insurance that's supposed to just make you healthy or give you a magical prescription that's going to make you better. If you actually had to pay with it in your pocketbook, you probably would think a lot more about the preventative care, the preventative things you might do with your life. Same thing with taxes. You'd get really upset if you actually had to pay a tax bill out of hand, which is why they go through inflation, which is why they have access to all that stuff up front anyway. One of the other things too, so I wanted to bring on other common objections to libertarian thinking from other veterans and stuff that I've come across, people that I work with, people that I've experienced online. So I want to bring some of that conversation in, because I know that is also out there. So while I certainly want to talk to those issues and I think they're important, just keep in mind that I'm always trying to point in the direction of making sure people are successful in what they're trying to do and whatever. I'm trying to push people into starting a new venture, trying to push people into thinking about capturing money in a way that actually helps them achieve their goals. It doesn't mean that they need to be the uber rich person. It just means that they need to make sure that they're controlling where they're getting their income from, how they're getting their income, and how they use it. That way they have that autonomy, that choice in order to actually impact their lives and the lives of those people around them. So also, one of the things that we'll get into as far as real estate investing with one of the interviews was you really should be working in your unique ability. And honestly, it's really hot right now in my house, and we had the heating and air company come by today, kind of talk with my wife a little bit while I was at work. But apparently, you know, I didn't know what was going on. I thought my daughter had turned off the thermostat, and I thought for some reason, somehow, some way, she broke it just by touching the thermostat. I didn't think how that could be possible, but turns out it wasn't her fault. So honestly, it's probably my fault, because I didn't understand how often I needed to change my filters, especially when it's 90 degrees outside for 2 months in a row. And you actually need to change that filter out basically every single month and make sure you actually have a really nice filter. And so I guess it started working slower and slower and slower to the point that it caused some of the coils and stuff inside the system to freeze because it's not pulling in enough air because it's so congested at the filter itself. So I'm not a heating air person. So again, you should stick, if you're going to get into real estate investing, stick to your unique ability. If you're a hands-on type of person, maybe that's where you need to be. If you're if you're somebody that doesn't want to deal with that, if you're somebody that wants to build a business system where you should be able to do everything from your phone while you're on the beach, there's ways to do that. And there's people that actually do that. If you want to build one where you're a lot more hands-on and you're actually fixing toilets, fixing heating and air, you're actually building houses, you're doing additions. We know some people, some Navy people here, they're actually going to come take a look at our house to see what additions we could do. And we're just going to get their perspective on it. Might even just pay them to do it. They're certified contractors and they're part-time. And that's one of the things that they enjoy doing. So again, stay in your unique ability, no matter where that is. But more specifically, it's for real estate investing as we get talking about it. My folks are actually intellectuals. And that's kind of the path that I was kind of put on, college grads. And it's like, you should, get good grades to get into a good college. Once you get to college, make sure you continue to get good grades, build good relationships. That way you can go get a good job. Once you get a good, safe job, you can work for them until you get a pension, and then you can, retire and then live on a fixed income, I guess, for the rest of your life, which is kind of, in my mind, somewhat of a sad existence. Not that I'm totally knocking it, but certainly was kind of the path that I was on, but it's not the path that I found out that I wanted to be on. So I'm jumping off that path, even though it did take quite a bit of a financial hit for me to actually get out. Plus there's other principled type stances that I took as far as becoming more anti-war. So one of the last things I want to talk about real quick is, if it does sound like I'm in a war zone right now, and I don't know if you happen to hear some of the other items that just went off, I guess, but it is Nebraska at the beginning of July. So that means as soon as the firework restrictions are off, kids go crazy. People go crazy, lighting stuff off. One of the coworkers I have literally every single year has a gigantic celebration of fireworks, which apparently is something to witness. And so I'm hoping that that my wife and I will be able to go out there this weekend and see it, because apparently it's pretty amazing and pretty astounding. So, all right, with all that being said, with some of the just silly talk up front, I wanted to get into it. So I know that I'm going to be the guy that says it, and you'll likely think that I'm absolutely crazy for saying it. But yes, I think the VA home loan for purchasing a new home, no matter where you're PCSing to, whether you're retired or whether you're somewhere else, I think it's a moral hazard. And in fact, I think so is the FHA loan. So I know what a lot of people are thinking. It's like, how could in today's dollars, in today's system, how could a normal person even afford a house at these prices that keep going up without saving 20% down? Like, how is it possible that I could save 20% down right now? That's going to take me years in order to be able to do that. And you're right, it will. But I will tell you that a lot of the people that actually go with a less debt strategy, even a no debt strategy, even though they sacrifice for years in order to do it, they are put in a very, very good position today. And I actually ran across a good friend that works with my wife and actually just PCS'd out of the area. And I was talking to him, and he has all of his rentals are 100% debt free, and they do very well for themselves year in and year out. Now, from they wouldn't necessarily be borrowing money from somebody in order to do that, because they're probably not going to get the return if you're doing investing, and obviously they could have leveraged themselves and try to maximize the amount of cash flow and everything else, because that's what everybody in a lot of cases is told to do. But sometimes maybe the more conservative approach might be better. So one of the things I want you to do real quick is to think about your experiences in PCSing and the areas that you've moved to overall. Actually, before we get to that, sorry about that. So, how could a normal person afford prices these days with saving 20% down? Like, how could you even get there? And that's absolutely a good question. And this also gets into the libertarian idea of what is seen versus the unseen, which Henry Hazlitt addresses in his brilliant book, and very easy to read, but very methodical in the way he goes out, called Economics in One Lesson, which is free to download. You literally can Google it, free Economics in One Lesson book, and find it. I can't remember exactly where some of it is. It might even be on Mises.org as a free download as well. Mises.org actually has a ton of libertarian literature. 100% for free. Even though you could go buy the book if you really wanted it out in on Amazon or at local bookstore or whatever, you certainly could find a lot of that stuff there. And they're not going to maybe have some of the newest books, but certainly a lot of the stuff that are in the libertarian canon, you're going to be able to find almost for free at Mises.org. And not even just that, but if you go to Mises Institute on your podcasting platform, at least I know they're in Apple Podcast, you're going to be able to find a ton of those books on tape. So they actually will have recordings of all that stuff that you can do through a podcast, which is awesome. It's how I got a chance to actually dive into a lot more literature when I wasn't able to read as much with time. So I'd use that time in my car to actually listen to a lot of that stuff and let that just soak in to my brain as well. So again, think about your experience in PCSing in the areas that you've moved to. Do you believe that the average house payment or rent payment that a local citizen, a local person that's not in the military is more or less than the average monthly cost of owning a home? And here's where it gets a little interesting, because everyone says you should possibly buy a home. There's the myth out there that we should be owning homes. And in reality, as Douglas French goes into, is that the myth of home ownership in this country was actually specifically perpetrated by the government, the banking industry, and the real estate industry as a means of getting more men who are coming back from war to build more homes. And especially once they saw the sheer amount of baby boomers and everything, they sold the idea and were able to profit off of the growing population, a rapidly expanding one, coming out of war, being one of the only people who can actually export labor and other things in the world that basically was broken, at least in the Western world, and being able to build companies and actually do a lot of that stuff from the World War II generation and the following baby boomers as well, where you're able to build the picket fence, the house with the picket fence idea, that the mortgage really becomes a huge factor here as well. The VA loan becomes a factor for a lot of the military members that are coming back from war around this time as well. And so that starts a cycle of the American dream, and at least what we know as the American dream today. But one of the distinctions we need to make about BAH, the housing allowance that military members get that is 100% tax-free, is that it's calculated off of a variety of factors. And in fact, owning a home, the cost of owning a home is not factored into BAH. And from my perspective, it shouldn't. The way that they do it makes a lot of sense to me, to try to be as equitable as possible. But here's a definition from the DoD Defense Travel website about BAH. So BAH is a U.S.-based allowance prescribed by a geographical duty station, pay grade, and dependency status. It provides uniformed service members equitable housing compensation based on housing costs in the local housing markets within the United States when the government quarters cannot or will not be provided. So BAH is based on rental market data of a geographical area, not mortgage information. The rates are computed using the current median market rents and average local expenditures on their utilities, their water, their sewer, their heating and fuel for each of those local markets. And it's going to fluctuate on those costs. And so those things tend to fluctuate year to year. And it goes into this big calculation that they do. And they'll go in and they have auditors that will go into different places and do it. And they'll also do somewhat of a cost of living adjustment occasionally every year, just like they do for base salaries for a lot of people to keep up with inflation. So again, it's based on rental data, and a homeowner's monthly mortgage payment is not used because the monthly cash outlay for a homeowner is not a good indicator of the actual economic cost of home ownership. A lot of times the variables needed to actually compute a lot of that is difficult to actually measure all of that as expected appreciation in the value of the home, of the residence, the amount of down payment, the opportunity cost of the interest for the down payment, settlement cost, the tax savings due to interest and tax payment deductions. Therefore, BAH reflects the current rental market conditions, not the historical circumstances surrounding various mortgage loans. And it also goes on to say that these are income-based minimum housing standards used to establish the link between housing cost and pay grade. And of course, members are not limited to the standard and are free to choose where and how they live. However, they are tied to that one duty location. Actual members' choices, however, do not influence the rate calculation. So if a person basically decides to live 30 minutes away because it's cheaper, or they live 30 minutes away in a more expensive neighborhood, they don't get more BAH because they choose to go live there. It's just based off the duty station, which most people, you probably already know that that's kind of how it's laid out for people. So it's based on the rental data that's there. And honestly, we went through a little bit of the mortgage data that's there. And so those, when it's talking about all that, it's talking about, you can't necessarily take somebody who, they might get a 0% down loan. They might get a 5% down loan versus somebody who's getting, 20% down. The monthly mortgage payments on that are going to be vastly different. Plus, there's also a way, which I'm going to get into, that you can actually get a home equity line of credit in the first lien position. So you eliminate your mortgage altogether and actually get a line of credit for the entire house. And you can even purchase with something like that, which we'll get into in a later episode of why that might actually be one of the best things you could do, at least from my perspective, on how it can actually accomplish multiple goals at a time. Let's see, what else? So one of the hard things that I have about getting into the BAH is obviously people try to buy within the BAH that they're at, and they know that that can fluctuate year to year, but they're not factoring in other things that are going to come along with it, which is why I start believing that it's much more of a moral hazard to do it. Now, I get the argument that people make that, well, if I'm just renting from somewhere, I'm throwing money away. And that, while that may be true to a certain extent, I would argue that if you are using every bit of that money that you're given in housing allowance, if you're using all of that, then yes, you're going to be throwing a ton of it away. But you don't have to use all of it if you can live somewhere not on base and actually collect and being able to pocket some of it to actually go use somewhere else. Now, do I necessarily think that you should still go do that? No, not necessarily. And we'll get into this in a second. So people tend to make their decisions based on their monthly income rather than actually looking at the long-term cost of doing something. When they buy a house, they're looking at what their month-to-month outlay is. When they're renting, a lot of times they're looking at what their month-to-month. When they're getting a new car, it's how much will the loan payment be and can it fit in my monthly budget? They're not looking at the overall annual outlay for themselves. And they're also not looking at the depreciation over, let's say, 5 years of a car. And they're not looking at the possible appreciation or depreciation of a house, depending on what neighborhood it's in. You might buy thinking it's in a great neighborhood. I mean, I can tell you that a lot of people look like geniuses who bought in 2011, 2012, 2013. Certainly in California, one of the nice things, what was the cherry on top, and again, this is a really stupid strategy to use as a real estate investor. It's not investing. It is just mere speculation. And you're just, you might as well just throw up a prayer, throw up a wish, cross your fingers, do whatever, because it has nothing to do with anything else but the actual market. You might have guessed right at the time, but I can promise you the people who bought in 2004, 5, and 6 who thought it was a great idea looked like total fools when it came down to 2007 and 2008. So if you happen to buy a property, so we bought one property in California in 2015, and we ended up selling it in 2018 in 3 years. And we actually made a little bit of money off of it because the house basically went up in about $45,000 to $50,000 in value in that 3-year period, which, oh my gosh, that's crazy. That's great. Well, the reason why is because of all the bad policies in that local area. You couldn't build a whole bunch of stuff that's there. There's housing restrictions all over the place. There's a lot more demand for housing than there actually is housing. And because you have all the other subsidies, then you also have the price increase of all that stuff, which also then prices out the very people that you are trying to help with subsidies and everything else. And you're actually creating a worse situation by increasing the cost of home buying by actually trying to help out the poorest among you. And I know that sounds totally counterintuitive, but if you actually just let the market help and keep it and allow it to actually be consistent, without handing out a bunch of money to people that you don't think can afford it, you're actually going to find that more people, as they strive to actually get into better situations, that the cost of those things would actually likely be down if you're allowed to do more building, if you were allowed to actually disincentivize people from getting loans that they're not really putting anything down. I mean, if everyone had to put down 20% on home loans, they would actually be more encouraged to save, which is a good thing. It's the basis for investing. It's the basis of a healthy economy. And overall prices on houses would be down. So you're actually trading. This is where the seen and the unseen comes in. If you are giving 0% loans and 3.5% loans to people, you are driving up the cost of real estate. If you're shutting off the amount of houses that people can build, you are also restricting the supply, even though the demand is growing, which also increases the prices. But then the more that you actually give help for people, whether those are subsidies or whatever, to buy and encourage them to buy with zero or little down, you're again going in that cycle of increasing the cost of everything, which still actually, from a month to month perspective, still has people living paycheck to paycheck and paying exorbitant amounts from month to month in housing costs, which is crazy. That's part of the problem when the government and the banking industry lobbies for this type of stuff to actually happen. This is why we shouldn't. This is why having a federal standard for mortgages and having a VA loan isn't always a good thing. So does the DoD spend billions in communities and localities? Yes, it does. But is that a good thing? So again, the issue for this, even though it might be through housing, it might be through just the presence of military and their income putting into the service economy that's there, or the building economy if the houses are getting built, or they're buying houses and stuff like that. So is the economic input from a military base to a local region is not, it's important to remember that it's not a natural free market decision of that local economy. Therefore, if a locality or a region has military employment as the main driver, if it takes up the majority, whether that's anywhere from 30 to 40 to 50, maybe even 60% of a local income, it's in the local economic input, or the one of the largest employers of the local community. While that seems great on its face, and I promise you politicians will pitch that over and over and over and over again because they get, kickbacks, and they get the ability to have more money they get more federal money put into their state, into their local place because of this. But the problem is that the more money and the more economic input that it has, the greater impact that it has. That also means the greater the distortion of true pricing actually is. So we can see this again in the housing sector, where a majority of locals live, whether that's rent or buying. Especially they tend to live in older neighborhoods. They tend to live a little bit cheaper. Their income doesn't necessarily match. There's much more of an income disparity between job roles and job titles. So even though certain jobs on base versus in the local community might make about the same, you're probably going to have more people on base doing that job and less people in the local community doing a very similar job. And so that creates a little bit of an income disparity, which also probably means that your professionals, your local, the military people who are living there are probably going to be living at a little bit higher standard than a lot of those other people. So because BAH is intended as a rental metric, we must look entirely at the median income of locals versus the military and what the median purchase housing at any given area. So it stands to reason that because the general demand is greater due to the military presence, that the housing demand, sales prices are higher than what the market truly would bear without the military economic input. More than that, military members and veterans benefit from having a 0% down VA loan that makes them more likely to buy something in a geographical area, which increases demand even more. The same goes for civilian population or anyone else who has access to FHA loans for 3.5% down. By allowing more people to buy without having the incentive to save 20% or have creative financing available or even readily practiced, like lease options, which is like a rent to own contract or a rent to purchase contract or a lease purchase contract, you ensure banks maintain a monopoly on mortgage financing. And it's exacerbated by artificially low interest rates set by the Federal Reserve. And this will continue to go down, and likely we'll see historic low mortgage rates in our future, because the Fed will likely push for a negative federal funds rate, which is one of the mechanisms that they actually use to control the rate of inflation or to be able to fund bailouts. Now, the Fed doesn't necessarily fund bailouts. It's a mechanism between the relationship with the Treasury and the Fed. Basically, in order to create this money to give it to the government, they have to buy a whole bunch of Treasury bonds, but they have to create that money out of nothing. And one of the ways that they're able to do that is basically then to create more money, which then allows bigger banks to go offer loans to other people. And because it's on paper as money, they're allowed to then up the ante with it. So this is the rate at which banks trade with the Federal Reserve and trade with each other. Or they're going to end up, through this process, they're going to be monetizing more debt and actually printing ourselves into oblivion, as they seem to be hell-bent on doing. So if you wonder why housing prices continue to climb and crash, it's because of this reason. It's because of the money printing. It's because of the relationship of the pseudo-private Fed with the Treasury Department, and actually making sure that they're controlling the rate of inflation and also bailing out big banks when apparently the big banks need it. If you wonder why housing prices, again, continue to climb, it's this one particular reason. And because people are incentivized to go into more debt, they're also penalized for saving. I went into this as an example in one of my other podcast episodes last about the car, about how if we go into the negative interest rate territory, not only is inflation going to continue to rise, but the fact that you're penalized at the savings rate level, you actually have to then save more. You're actually coming up thousands of dollars short because of the impact that compound interesting will have in the negative direction if you actually have to pay the bank to keep your money. And you had asked the question of, like, why would I pay the bank to keep my money? Why would I even keep money in my savings account or my checking account? Well, that's because everyone is so used to it. Our entire system is built around this principle of using these banks with the checking and the banking and the savings portion of it to do this. And well, maybe at that point, you should just start putting cash in your it might be very likely that if the negative interest rate goes down too low, that, it might be better to put a whole bunch of cash under your mattress or bury it in the yard or something like that, as you save the money to actually go do something. It might be more beneficial to do that, except when they want to start banning cash altogether and actually hurting people that use cash. And so every year that goes by, your cash will actually be worth less and less, specifically if you're going to use cash. They might add a surcharge, or they might add another fee on top of that as a way to phase out cash altogether. And these are things that are currently being talked about. So I certainly don't want you to think that I'm talking out one side of my mouth like I don't know what I'm talking about. And I certainly can go into this a little bit more, but these are things that are being talked about right now. Especially like, how would you get your UBI? How would you get your universal basic income? There's already ideas that are coming about that maybe you should have somewhat of a bank account that's attached to your Social Security number, and how you actually receive money from the government, especially like if you're going to get a bailout again, you have to prove to them that you actually have this account set up in order for them to do it. And they're not just going to give you cash. They're not going to just send you a check. You have to have this debit card or this certain bank account in order to do that. And that's one way that they can keep it in ones and zeros rather than actually having cash. And the thing is I believe we only, out of the entire economy that we have, less than 1%, I think, is actually in cash. Even though you see cash every single day, the amount of money that's out there, the trillions and trillions of dollars, we only have 1% of that actually in physical cash circulation. So that's something to think about. And we can get into runs on banks and a whole bunch of other stuff. Honestly, you can read a whole bunch of other books that I have for you. So, everything from the skyscraper curse to how the skyscraper curse to how privatized banking really works, to the everything bubble. And they'll go into this concept. Each one of those will talk about this concept specifically. So what I want to get into now is a little bit more of the why I think this is quite a bit more of a moral hazard than people think it is, and how the system is kind of set up, whether that's intentionally or not. So the average tenure of a homeowner is 5 to 7 years, although in the last probably couple of years, it's climbed up to 8 years. So 5 to 8 years is the amount of time somebody stays in a home or owns a home. Now, you know, as a military person, that you're moving 10 to 2 years, 4 years, 5 years, maybe somewhere. Probably 5 is really on the end, but typically 3, depending on. So we'll say 2 to 4. But if you were to type into a mortgage calculator or look at the truth in lending statement, you'll see that the bank actually makes 60 to 80% of the value of the home through interest payments. And because it's a mortgage structure, you'll pay almost 50% of the interest in the same 5 to 7 year period. I want to say that again. The bank will make 50% of the interest payments in the first 5 to 7 years. It seems to me that it's a weird correlation that the amount of time you spend in your home is also the same amount of time that they make the most money. I'm not denigrating people that make money per se. I'm denigrating people who go to the government to create institutions that strictly try to segregate you from your money. And this is why I say VA loans are a moral hazard, because your only saving grace is that you live in a locality that has great appreciation. Again, that's a dumb, terrible investing strategy, as many military members and veterans and Americans found out again in 2008, 2009. Part of the problem is that people look at a house and think that if they buy it, then hey, it's an asset. And we talked a little bit in my last podcast, you should treat your skills and ability to work as one asset, and your investments and your cash flow management strategies as another asset. Basically building your own bank and building your own workforce, using your skills, using your tools, using your employment in a way that gains more skills and makes you more valuable. So in fact, you should treat yourself and your life like a productive company, just as Douglas McCormick talks about in his book, Family Inc. When you develop your family business balance sheet and you slap your mortgage on there, you'll find out very quickly that it's in the liability column. A house strictly is not an asset. Yes, there are benefits to being a homeowner that the tax code lays out, but it comes at a cost as well. The cost of ownership, the maintenance, the repairs, the capital expenditures, all of that stuff. Now, some people may relish that, love it, but again, it's not putting cash in your pocket. It is not strictly an asset until you put it to use. So if the government tells you that it's good for you and provides a tax incentive, what I can say is just assume that if it can benefit you. But it means also to benefit the lobbyists and the industries that ask for the tax code to be written in that way in the first place. The banks make a killing off of separating you from your earned income. The government gets a run at your paycheck first, then your bank gets a run at your housing costs, whether you're renting or not, and makes money even every month on mortgage payments, but incentivizes you to become an owner. As many people as possible with programs and tax incentives, that's how they get to you. But many of those incentives you'll only see as adjusted taxes at the end of the year, which when comparing yourself to the Joneses next door that are renting might seem like it's a great in comparison. So you're making out like a bandit because you have a whole bunch of standardized tax deductions. You might get a little bit more. And honestly, some cases you might get a lot. Some cases it might be a few $1,000s. And hey, I'm not knocking getting your money a few $1,000s back from the government. I'm not knocking that. Just remember that you gave the government that $1,000 as a 0% interest loan. But I think this is also a false comparison, because you're getting both. You're both getting screwed by the banks and the government that have incentivized the spending and the borrowing and the saving and investing. Yes, you have agency to choose something different and find a way that doesn't keep you in turmoil of debt, but it will directly go against the incentives that they have laid out for you. So if the average tenure of a homeowner is 5 to 8 years and the banks make over 50% of their income on interest payments in that same 5 to 8 years, and you pay 0 to 5% down, your typical break-even point when you go to sell will occur within your years 5 to 10, unless there's a significant appreciation in your local market. So how to create more demand? So you got to lower interest rates. They will try to give you more benefits, more tax incentives, more subsidy programs. They increase the buyer pool by lowering application standards. They implement rent control, housing development restrictions, all of these things that we've kind of already talked about. And these policies correlate to the rise and the fall of home prices, some more directly than others. But in order to keep it going, banks are incentivized to keep lending out money out of the fractional reserve banking model. They must give loans in order to make money. And each subsequent year, they must give more loans to keep up the pace of profit and to keep with or outpace inflation, which has also increased even with the lag time because they've been bailed out in the past. And they're going to anticipate getting bailed out again or finding another way to make sure that they're taken care of at the expense of their shareholders and other people who are their customers. There's a direct correlation with inflation and the increase of debt, whether it's personal, corporate, or government debt. As one increases, the other must expand as well. This growth is absolutely unsustainable, and the responsibility lies at the feet of the Federal Reserve, the major banks, and the U.S. federal government. The next bubble to burst, and the one that is bursting, no matter the Band-Aids we're trying to put on it or the propaganda for the reasons you could put in COVID-19 is actually a function of the corporate and the government bond market. We've expanded that. And again, everything bubble talks about that. And I think it provides a fantastic case for how they use these highly regulated industries in order to segregate people from their money to do that. Today, we are not seeing unrestrained capitalism doing this. We didn't see it in the past. We haven't seen unrestrained capitalism causing booms and busts ever. We're seeing cronyism from large corporations in collusion with the federal government and the Fed and the U.S. Treasury, which are now directly buying private debt, which means companies are now partly owned by the government. This is not a free market in the slightest, nor has it been for a very long time. In fact, it never truly has, so long as corporations close to power continue to ask special favor and treatment from the government with people with power. I don't think the government can ever be independent of this. I don't care what system you put in place, the government will not be independent of this. It will choose winners and losers for whatever moral reason that you might have, whether you're a Marxist, whether you're a socialist, whether you are a Christian conservative trying to impose your values on other people. The government, whoever is in control, whoever is the person that's deciding what laws are going to be implemented, it is going to have their moralistic tendencies. And in a lot of cases, they're not going to let people just live and let live. So let's get back to real estate for a second. So you'll likely lose more money as a military member through ownership than through renting. Now, this isn't always true. This is a case-by-case basis. This is locality by locality. This is person by person, how smart you are with it, how diligent you are, how you're living under your means. But by and large, if you're just looking at it like most people, you'll tend to actually lose more through ownership than you will through renting. Yes, you'll get some of the benefits. But especially if you, like other veterans and military members, move every 2 to 4 years, you'll find yourself as an accidental landlord with a mortgage payment that barely covered the rent. And because you don't know about being an investor or a landlord, typically, you will quickly find out there is a ton of risk, and you're at even more risk with a high debt load on your investment because of the VA loan. But my rent payments are $1,500. My mortgage is $1,200. See, I'm cash flowing $300 per month. That's $3,600 per year. Indeed. Congratulations. Are you factoring in the cost of management, which is 8 to 10% of your rent typically? Fine. You don't want to do property management? Great. Good luck to you. How about the cost of annual maintenance and repairs? Are you putting aside 3 to 5% every month or more? What about the home warranty? Did you decide to go with one that could be $50 to $75 per month? And does your tenant and property manager actually understand the procedure to initiate a home warranty service order so that you're not stuck with the bill if they don't follow it? What about capital expenditures, roof replacements, concrete, window replacements, other items that your warranty won't cover? What about a tenant and the related damage that they might have? Sometimes you get fantastic tenants. Sometimes you're going to get terrible ones. Do you have the cash reserves to handle the vacancies based on the vacancy rate of your property, the local area, and what demographic your property caters to? And I'll give you one example, which is very common. So if you have to replace a roof and you're only making $50, let's say up to $300 in cash flow, your profit will probably get eaten up very quickly with large, major capital expenditures. Have you planned for those expenditures and the remaining useful life? Do you actually know when you're going to have to replace those large expenditures? Your roof, the sidewalk, the fencing. I mean, you name it. This is one reason why I think getting into the VA loan on active duty, you need to read things about becoming a landlord, about being an investor, the cost associated with selling in the future to determine whether you should be buying the house at the current price today. I think when you look at it, you should be buying a house based on a cash flow outlay that you can project at least over the next few years and totally exclude the idea of appreciation from it altogether. The question would be, when you go to buy, does it cash flow? And because VA loans have to have a VA appraiser and have to live up to certain standards, the likelihood of you being able to find a house that cash flows in certain markets as the prices continue to increase for all the reasons we've talked about, I find that is going to be a very hard sell, which means in order to find the right properties, you're probably not going to be able to use a VA loan to begin with. And one of the guests that I talked to, one of my good friends, he talked about, yeah, he got into it that way a little bit, but he also lived like no one else. He lived off of $1,250 a month as a single dude in Montana. He drove just a terrible car for Montana, but he owned it. And he did that for a few years so that he could live like no one else years later, which he was able to do, which he was able to put a ton of money down to buy 3 different properties in 1 year and also take that $1,250 that he was used to living on. And now he made every bit of that in the real estate income that he had. So there's plenty of successful examples. And again, I'm interviewing some of those this month and you'll hear from him. But there's other options as well, which we'll get into, which I think are very important to at least consider. So some may say at least that I'm gaining equity in the house if I buy it. But remember, you are relying on a manipulated market to determine this unless you are willing to run the numbers as an investor, make a solid plan, and accept the risk, accept what is understood risk and what is the unknowable risk. Just like your retirement and your medical benefits as a veteran or retiree, you don't control that stream of income, nor the benefits. But because you thought it would be there, you sacrificed maybe good decisions yesterday for the promises they gave you for tomorrow. This is one of the hardest things that I came to grips with, caused a lot of cognitive dissonance for me. And my big question is, how well do I think, or you think, the government will hold to its financial promises for you? And one day I promise I'll find this when just the cynical politician that's out there, when they're talking about the different amendments for the Social Security Administration, as they're trying to check and make sure that people will get their benefits, as they're enrolling all these people. Is it even solvent? Well, they're now doing a shell game with having a trust that's set up that invests in the market. Well, still, most of the politicians will just say that they'll print the money. Yes, we'll pay you what you owed. It won't be worth anything because we'll have to print it to get there. One of the things I want to go back and readdress real quick is the idea of the mortgage that you have being a asset versus a liability. And this will be the topic of the next solo podcast that I do after I do a few of the interviews with other real estate investors. And it'll get into the idea of how you can use your home equity as an asset, functionally as an asset. And in reality, it's the ability for you to marry your income, your ability to work as an asset, marrying it with the home equity in a way that, number one, helps you pay down a mortgage faster, or at least pay down the debt on your house faster, at the same time that allows you within the margin that you have, that's what's most important, that it allows you to be able to debt consolidate a lot better. It allows you to accelerate a lot using the same snowball strategies that even Dave Ramsey talks about. No, he would not endorse the strategy that I'm talking about by any stretch. But even with that strategy, you still have to understand that when you're purchasing a home, you have to ask, is it actually, if I, worst case scenario, had to sell the property or I had to rent the property, will this cash flow in a way that actually puts money in my pocket after all expenses have been covered? And are you willing to go to that extent? Are you willing to take on that much risk? So with that, we'll get into more of the solutions. I'll talk a little bit more about the line of credit with the housing strategy, but I'll also tie in a little bit more about the infinite banking concept again, because I think those two strategies together are very, very, very powerful to making sure that where the bank is trying to segregate you from your money, you're able to then capture as much of that back into your own income making potential as an asset, and building your own personal bank as an asset that you get to borrow from and profit from, rather than using the bank to do so, and getting to a point where you no longer need a bank. And hopefully, as I build the Cash Flow Veteran out, we can help support each other. We can build private equity. We can build things that actually are supporting other veterans for a number of purposes. So again, just understand when I say these things, I am coming from a libertarian perspective that have led me down, but these are also very practical things to think about for a VA loan, for real estate investing. And honestly, with that, let's go ahead and get into the real estate investing. So tune in back for episode 13 next week, and we'll get into some of the investors I was able to get some great interviews out of. And I'll see you then. With that, take it easy, Cash Flow Veterans. I'll see you next time.